So you'll never believe this. My friend bought a used car. He tried to get a loan through three different banks, and they told him they have no money to loan him. Whew. Folks, ladies and gentlemen, this is likely to become a big, big problem here moving forward in the future, with banks not having the ability nor the courage to lend money. And this is going to have a huge impact and a huge effect on so many people in so many different ways. But first, I want to take a look at this.
The Federal Reserve went ahead with a 25 basis point rate hike. Will these forces push us into recession? Joining me now is Bank of America head of U.S. economics, Michael Gapin. Michael, thanks a lot for coming on the show. Appreciate it.
Thanks for having me on.
So obviously all the eyes have been on Jay Powell for years now, but with this banking crisis or mini banking crisis, lending standards have been getting very tight. And I've heard anecdotally that some of the smaller community banks have almost shut the door. With those two things combined, how much will that slow the economy?
Now, this is more than just how much it's going to slow the economy. This really boils down to how it's going to affect people day to day. And folks, this is not me trying to bash small banks. This is not me trying to convince you to take your money out of the banks. And this is not necessarily a debate of whether or not the banks are better than credit unions or are credit unions safer than banks. But I do want to point out that I do have something shocking and alarming to share with you, as I received an email from my credit or one of my credit unions just 2 days ago about a potential problem at the bank or at the credit union. And I'm going to go over that here in just a moment, but I want to see what these guys have to say, or at least I want to share with you what they have to say, because it's really important about the future of our economy, the banking system, lending, borrowing money, possible recession, depression, higher inflation, higher interest rates, the whole nine.
Right. Well, that's the big open question. And I think, to some degree, this should be expected. This is one of the main channels through which the Federal Reserve can slow the economy. So we should expect lending standards to tighten. We should expect loan growth to slow. The question is essentially, have recent events meant that we're going to get a lot more tightening than we thought? So excess tightening or unanticipated tightening. So is there a credit shock, a credit crunch around the corner? So it's true that loan growth was slowing coming into this event.
All right. So what I want you guys to really pay close attention to here is the delicate line and balance that this Michael Gapin, Bank of America Securities head of U.S. economics, is trying to walk this line where he's not necessarily lying on camera, but also not inciting too much fear and panic in the public by actually providing real answers to the questions, providing the truth. Let's listen on.
Probably slow further. And so if we get a lot of excess tightening, yes, it's going to do some of the Fed's job for them. And I think the Fed said that this week.
Yeah, Jay Powell did, yeah.
Fed, he essentially mentioned that. And yeah, and it's probably a disinflationary shock in that world. So the Fed may have to tighten less. Slower loan growth or even declines in loan growth would help the economy slow down and bring inflation down.
So when you combine those with the 25 basis point hike and all the other hikes we saw before that, has the Fed essentially been too aggressive? If you look at year over year, inflation is pretty high. But if you look at more recent indicators, Case-Shiller housing index has been down 6 straight months, and I think everyone expects next week we'll see a 7th straight month.
Yeah, so the basis point hike, this 25 basis point hike, the continuous bullish nature of Fed Chair Jerome Powell in raising interest rates after having seen the negative impacts that it has had on these financial institutions like Silicon Valley Bank, Signature Bank. They're continuously pushing this plan that they have in place to almost destroy the economy, but really more so in the process of raising interest rates and trying to bring inflation down, which disinflation is not the same as deflation, and driving people to job loss, which the whole job loss and jobs created numbers, which we're going to talk about here in just a minute, they're a little bit skewed for the fact that if, let's just say, Amazon. Amazon's in the latest that just released an announcement that they're going to lay off I think it's another 18,000 workers. Okay. So let's just say 18,000 workers lose their jobs. You would think that that would create a deficit. But instead, these 18,000 workers, and maybe it's not 18,000, maybe it's another number, but these 18,000 workers are then going to have to go get new jobs, possibly get additional jobs. So maybe let's just say they get two jobs to replace the income from the one. That means that you would actually see from Amazon reducing 18,000 jobs, you would actually see the numbers report an increase of 18,000 jobs. You see what I'm saying? Because these people would then be working twice as hard for half as much money.
That's worrisome.
It is. I would say it's too early to know. I don't think the Fed's done too much. Certainly housing has slowed, business spending on structures and equipment that slowed, manufacturing production has started to come off.
In these year-over-year numbers, they haven't caught up yet. So eventually we're going to get to a point of which, even if the Fed did nothing, we would get to a point of which I shared with you guys on a previous video, that mathematically we'll get to a point where inflation has been so high for so long that year over year, they will end up automatically balancing out to this target 2%, which is going to be more so controlled by businesses and the leaders of the economy, those that are really pulling the strings behind the curtains, determining what they're going to charge for everything, which ultimately means how much they're going to make. And this comes like from the top of, or even the bottom, depending on how you're looking at it, from a raw materials provider all the way to the final product production before it gets to the end user, with something as simple as the semiconductor chips. Having started that would be the building block of, okay, how much more do we want to charge and how much more do we want to make? All right, this is the number. All right, so then the silicon semiconductor chip manufacturers will say, all right, well, we're going to raise our prices to this point to get to that. That way it doesn't just look egregious, but then at the same time, it's like, well, we can't just do that, because then we'll get backlash from, the public basically. And so instead we'll just, start ramping down production, because as we reduce supply, maintain and or ultimately increase demand as a result, then we can raise prices and everything is okay.
So this is kind of the next step. Bank loans and standards are tightening, credit growth should slow. It's hard to argue we've over tightened if we just added 311,000 jobs. And
there's that jobs number. Okay. I don't trust it. I don't believe it. I don't like it. And you guys, please comment down below and let me know what you think. Are you seeing job growth? Are you seeing increases in your income? Are you seeing greater opportunity? Or are you seeing more jobs being tacked on just to get by, just to make ends meet? No right or wrong answer here. We're just trying to get down to the truth.
Essentially, it's an investment-led slowdown right now. We suspect it'll transition to a consumer slowdown later this year. I don't think the Fed's overdone it, but we'll see. We could get a very large negative shock to credit growth out of this, and the Fed could have to backpedal. But right now, the data doesn't suggest that's.
Yeah, so the consumer pullback is going to be not as a result of the higher interest rates, because we can see here, based on that chart that was just up on the screen just a few minutes ago, it shows that we were seeing consecutive 75 basis point increases on interest rates, and it didn't stop people from buying and spending. Job loss didn't stop people from buying and spending. Uncertainty didn't stop people from buying and spending. And even these recent banking collapses aren't necessarily keeping people from buying and spending. But what will do it is control by the central bank, which we are moving towards with this FedNow system and introduction of CBDC, central bank digital currency. But what you're going to see here as we go through all this that I have here for you, all the research that I've done, everything that I've prepared, we're going to see how much more the Fed, the central bank, is going to intervene in banking, Very, very shocking, very disturbing.
Case.
Well, certainly the jobs is that one thing that has really held up to some people's surprise. You, however, have been predicting a mild recession, or at least you said the odds are pretty high of a mild
Right.
recession. Anything in this past week change your mind, make it more likely?
I would say the events of this past week have opened up downside risks to our outlook for the first time in what I'll call the reopening phase of the pandemic, when the economy has just shown a lot of strength and wanted to keep going. So I would say kind of it's twofold. One, the path from housing to business spending to manufacturing to bank lending, that's very consistent with the slowdown, so it makes me comfortable with our outlook overall. But I do think these events represent downside risk to the economy.
Now he's feeling comfortable because more than likely he earns, a ridiculous salary, which let's just see here. But he's going to feel comfortable because he makes a lot of money, okay? And he's also behind the scenes and he knows what's happening and more importantly what will happen in the future, folks. Please believe, okay? But the other thing is that he's continuously trying to massage this in a way to not necessarily tell every detail and alert people of what's actually happening. And what's going to be most important is for moving from this day forward is continuously trying to make more money, spending less than you make, budgeting, eliminating debt, saving, and investing. Easier said than done, but what we have coming, borrowing money for any particular reason, is either going to be too expensive or just not an option. Please stay tuned.
Which could mean the Fed, there are worlds in which the Fed's going to have to shift to precautionary rate cuts as it's done in the past, or maybe even move to outright rate cuts quicker. We'll see. But yes, it makes me kind of feel comfortable with where we are.
The Fed's, in my opinion, we're not going to see rate cuts anytime soon, and they have a plan. They have a strategy that they have put in place.
Okay, so in addition to fighting inflation, I think the Fed's original mandate back in the early part of last century was actually stability in the financial sector, and now suddenly that's a real issue. How do they find a balance between not wanting a run on the banks, but also not giving bankers an open door to take lots of risks because, hey, the federal government will backstop it, the so-called moral hazard?
The moral hazard are.
How? The simple answer is CBDC, central bank digital currency. Now, granted, we're not there yet, but it's almost as though they are dipping their toe in the water with what the central banks, the Fed, how much money they're giving to the banks. Again, folks, I have a lot to cover here with you guys, but that's the how. How do they prevent the run on the banks? Well, ideally, in a situation, they would control the banks and they would just prevent it from happening. But even more so is what they've actually been doing and are instructing and directing these big banks, these banks that are too big to fail, to do. Granted, this could potentially lead to smaller banks being wiped out. Now, banking crash, banking collapse. I mean, theoretically, technically, Silicon Valley Bank didn't actually crash, fail, and collapse. They were just they were shut down by the FDIC to prevent a catastrophic failure. They lost 25%, I believe, of their deposits, but they didn't collapse. They were not on a great track for success in trying to mitigate and manage this risk of bank runs, but they didn't actually crash, collapse, fail. That was halted by the FDIC, by the Treasury, by the Biden administration, by the Fed, and so more than likely we won't probably see the smaller banks eat it, but they will not get the same treatment as the too big to fail banks as these too big to fail banks start accumulating and acquiring and purchasing these banks, these smaller credit unions, these smaller financial institutions, then moving forward towards a complete takeover. Now, this is going to have a huge impact negatively for people who rely on these smaller banks. But again, we're going to get into that in just a moment.
Argument, right. So certainly the first and foremost, you do have to respond to events if you think that there's a systemic risk event there. That's essentially what they've done. And you're right, that was the Fed's original mandate. And in some ways, and I don't want to make this overly literal, in some ways it's good that the shock happened in the banking sector. The Fed's good at understanding these issues. It has the tools to go fight them directly and the experience. So
this is somewhat of like a stress test, basically. And on a small scale, granted, Silicon Valley Bank, SVB, was the 16th largest bank. So they were able to test and see how their plan, how things would work, how the reaction would be, as well as it was somewhat segmented or segregated or isolated to the tech startup industry and not so much individual consumers. Although it did have a huge impact and effect on payroll. I received an email from my payroll processor, system as a service, SaaS, and I'm sure many others experienced the same issues as they had funds tied up in SVB as it was temporarily locked down, shut down. Additionally, Etsy saw problems with being able to get payments out to their sellers, and a variety of other issues that resulted from the FDIC coming in and shutting down Silicon Valley Bank, SVB, temporarily. But this was the test.
I think there's experience there that should help us out. But you're right. Every time we do that, it raises the risk of moral hazard. What will likely be coming down the road then is additional regulation, maybe to some degree the reversal of the rules in 2018 that reduced regulatory burden on banks with 50 billion to 250 billion in assets. So in general, you come back with typically more regulation, and to hopefully that you ensure the incentives between bank owners and their shareholders.
More regulation, more control. This moral dilemma, that this moral risk, is going to come in the form of pain, folks. Jerome Powell himself said it before. I'll say it again. Pain will be felt by businesses and families, but the businesses are on the inside. Some of them, for the most part, the big ones, the ones that have the major players tied into this, the families, those who are already financially at risk, those who are already towards the lower end of the income socioeconomic spectrum, those are the ones who are going to feel the greatest amount of pain.
As long as it's smart regulation.
That's right.
They missed it this time around. One more question for you, a few seconds left. It seems that there isn't much reason, if I'm being mercenary about it, to go with a small bank right now. If I had a big payroll to meet, I might think, gee, I'd like to put that with one of the too big to fail banks.
And what he's describing is literally a business-based bank-run scenario, folks. This is not about you and I, the average consumer, hitting an ATM or grabbing a few $1,000s out of the bank. No, we're talking about hundreds of millions, if not billions of dollars collectively. That this right here on this video, you can see Fox Business in this Barron's Roundtable interview, the push for more regulation in banks is basically trying not to, so eloquently put it, incite bank runs from businesses, but he's asking the question.
Is there a danger that money will continue to flow out of the smaller institutions?
Yes, I think you could argue high yields on money market mutual funds are causing deposit outflows, and recent stress events could lead some deposits to flow into bigger banks.
No, it's the risk of not having the ability to have access to your capital, your deposits when you need them to make payrolls and continue operating as a business, as well as the inability for these companies, these businesses, to have access to lending and credit, even have access to it, or let alone at an affordable rate to repay. To each their own.
We think that will be an ongoing challenge over time.
But I'll let you guys decide. Feel free, comment down below. We've got a lot more to go through here. Speaking of this tightening, this comment here says that you will never believe this. My friend bought a used car and he tried to get a loan through 3 banks, and they told him they have no money to loan him. He ended up having to go through the dealership, and they had to do the footwork on a used car, $12,000. And he told me that he's doubling his payment on his loan because he's doing a lot of overtime and he works for the state. which is going to be very, very important here. And it's good to hear that, because what I want to share with you is this clip here. Let's see if I can get to it. And we're going to discuss some of these comments too on this post, because, people are looking like, whoa, this is crazy. I can't believe the banks don't have any money. This is not going to be good. He should have paid cash for a car. If you have to finance it, you can't afford it, plain and simple. The fact that he had to work so hard to get a loan should have been his wake-up call. Now, this is I don't want to get off track here or off target, but we shouldn't be making blanket statements like, well, he should have paid cash for a car. If you have to finance it, you can't afford it. I mean, that you guys comment down below and let me know, but even, $12,000, you got to think everybody is in a completely different financial situation than everybody else. And, it's not like they were trying to go out and buy $100,000 car, which even then some people may not necessarily be able to or want to plop down $100K on a car, especially prior to when interest rates were way better. There's no way I would have been spending my cash when I could have been borrowing money for basically free. But that statement right there really kind of gets to me, because I don't think that that's necessarily true. I think there's a lot of different circumstances that are going to have to be taken into consideration on whether or not financing a car is a good idea or a bad idea. I would probably say more so the interest rate, because that's what I'm about to show you guys. But if the interest rate is obscenely high, then that would be a clear indication that you should probably pay cash. Not because you can't afford it, but it's just going to hurt you long term with all the extra payments going, or all the extra money going towards the interest payments. But let's just see here. Used car interest rates today. So on 12 grand, trying to finance this car. And this is not so much about the person borrowing the car. This is about the situation that the banks are in. Now we're seeing 60 months on, or let's just say 48 months on a used car, 7%, 7.03, 36, 6.74. If you were to stretch it out to 60 months, it probably raise it a little bit. But for argument's sake, let's just pull up the calculator. And let's just say it is a new car. It's not, because you're not getting a new car for 12 grand. But let's just say you can get the best rate of a new car. You have good credit, excellent credit actually for that matter. Let's run through the auto loan calculator and see what that would look like to borrow that kind of money. Because the banks are looking at it the same way that we're looking at it, just inverted basically. So 12 grand, 60 months, 6.5%. And you can see here, that'd be $235 a month. And if you guys ever want to know how this works out as far as principal and interest payments, you can go and hit the amortization schedule and just see every single payment and how each payment towards maturity ultimately goes more towards principal and less towards interest. But the bank's looking at it saying, look, we can make $2,088 on this loan. And if the bank is saying that there's two reasons behind this. If the bank is saying no, they're saying that the risk is too great and or we don't have the money to lend out, therefore we're out. And or they're saying our faith in the automotive industry and the values of vehicles is so low that we don't want to be upside down on this loan. There's a lot of banks upside down on car loans right now in the middle of repossessions, and big ordeals going on with some of these dealerships, Carvana, some of these smaller car lots, as well as the future of the economy and the ability for the borrowers to repay, i.e. inflation, higher interest rates across the board, higher prices, and job loss. These are key indicators, folks. Banks, here's the big deal. Banks are borrowing more than usual. And as of Wednesday, banks were borrowing $53.7 billion. According to the Fed data, the previous week, it stood at $11.9 billion. That's a $42 billion, almost $42 billion jump in a week. So the banks are borrowing, but they're not lending. But more importantly, who are the banks borrowing from? Oh, they're borrowing from the Fed. They're borrowing from the central bank. Banks are borrowing at financial crisis levels, folks. Banks continue, Barron's reports that banks continue to borrow from the Federal Reserve at historic levels approaching the 2008 to 2009 financial crisis in the past week. On top of banks, smaller banks for that matter, declining and rejecting or not even accepting applications for lending. This is going to be a huge impact. This doesn't even matter what your credit score is. These banks are afraid. They're afraid, they're scared, they're panicking, they're worried, and for good reason, because they know what's going on. The collapse of Silicon Valley Bank on March 10, followed by Signature Bank on March 12, prompted depositors to pull their money from some banks and sent the stock prices for financial firms on a roller coaster ride. The tumult has left some institutions looking for a ready source of cash, either to pay back customers or to make sure that they have enough money on hand to weather a rough patch. These banks are borrowing money. They're borrowing money to repay depositors who are looking to get their money back. Does that make sense? Does that sinking in? This is fractional reserve banking. This is the weak link of this mental construct of the financial banking institution at play. And as they're borrowing at record amounts from the Fed, central banks, they are not lending. Now, this could be because they can't. They're worried. You see here, making sure that they have enough money on hand to weather a rough patch. But more so importantly, the Fed may have restricted them and told them, you can borrow this money, but you cannot lend it out in the form of auto loans or personal loans or even business loans or home equity loans or consolidation loans. I'd be willing to bet that there are some stipulations on this borrowed money. Why? Because the Fed is trying to execute on their strategy and their plan, and it didn't work through interest rates. So instead, they'll make it work through the money that they will allow the banks to hold or borrow, so to speak, but not allow back into the economy through lending. And that is where the Fed comes in, folks. The central bank was founded in 1913, partly to serve as a backstop to the banking system. And it can loan financial institutions money against their assets in a pinch. It can loan financial institutions money against their assets in a pinch. Therefore, we are in a pinch, okay? But the Fed is now going further than that. And central bankers on March 12 created a program that is lending to banks against their financial assets as if those securities were still worth their original value. It sounds like the exact same problem that Silicon Valley Bank was up against. Meanwhile, by lending against the assets at the original price instead of their lower market value, the Fed can insulate banks from having to sell those securities at big losses, and that could reassure depositors and stave off bank runs. So it's clear, folks, they're kicking the can down the road, but in the big picture, all they're trying to do is keep us calm. They don't want us to panic. They want to avoid bank runs, but they're not going to let you borrow any money. Eurozone banks cut lending even before latest financial turmoil. And this was the decline in bank lending for businesses. And it says here that decline in bank lending could deepen as financial institutions move to retain deposits, strengthening effect of ECB rate moves, and consumer lending is next, folks. We're seeing it firsthand in the comments. Hopefully, you guys will provide me with some more information, either to further prove this theory or debunk it. Either one, perfectly fine with me. But I'm reading to you guys the facts, the information that I have available to me, and information that I'm sharing with you based on my experiences and people that I've been talking to in these financial spaces and what is likely to happen moving forward based on historical trends, patterns, events, and likely possible scenarios. I don't have a crystal ball, but I do have, some matter here between my two ears that I can put put to use to try to determine the best way to plan and prepare moving forward. Because tomorrow will be a new day, but will we have money? Will we have lending? Will we have resources? Will we be in a bind, in a crunch, or will we be making forward progress? Financial Times says that American banks are facing a looming credit risk as consumer behavior changes. The business model of small and medium-sized lenders is under threat. Folks, this just means that we're going to see these smaller banks, these local banks, medium-sized banks wiped out. First, it's going to start with a reduction in lending. Second, it's going to move on to being mergers and acquisitions, all being lumped in and consolidated into larger banks. Larger banks borrowing records amounts of money from central bank, the Federal Reserve, moving towards the push of a central bank digital currency. As Jay Powell, Federal Reserve Chair, said on Wednesday, a 25 basis point hike was pushed out yet again, despite the possible consequences that we have already seen from Silicon Valley Bank. But these consequences don't necessarily really phase the Fed Chair Jerome Powell because they have a plan, okay? And it says our banking system is sound and resilient with strong capital and liquidity. Okay. I mean, when you determine that, when you hit the button on the computer and you add some ones and zeros, we're no longer printing money here, folks. And also, the Fed supplied an eye-popping $152 billion in liquidity to banks last week. $152 billion in liquidity. Meanwhile, the banks are not lending. Think about it. And before SVB collapsed, it seemed that systemic meant big banks. Hence, when SVB, Silicon Valley Bank, and Signature wobbled, customers moved funds to the too big to fail giants. However, the FDIC then subtly reinterpreted this mandate and protected all deposits as SVB, Silicon Valley Bank, and Signature, supposedly because of systemic contagion risks. As Powell noted on Wednesday, and I quote, "History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole," end quote. But as we can see here, Janet Yellen, U.S. Treasury Secretary, also revealed on Wednesday that the Treasury and FDIC do not plan to offer blanket guarantees for depositors in advance without congressional support. Therefore, Silicon Valley Bank, Signature Bank saw the FDIC, the Treasury step in and provide protection to depositors above the $250,000 FDIC insured limit. Unheard of. But what she's saying here, what Janet Yellen is saying here, is that they do not plan to offer that same blanket guarantee for depositors in advance. Therefore, my guess would be if a smaller bank were to collapse, crash, odds are any smaller bank, medium-sized bank with accounts above the FDIC limit will probably not get the added support and bailout, although Biden said it's not a bailout, from the FDIC like we saw Silicon Valley Bank, SVB, Signature Bank. And it says that the next issue is the bank's business models. During the past decade, banks enjoyed abundant, cheap funding because their customers left their money in low-yielding bank accounts due to a lack of better alternatives. And the banks then made profits by extending loans at slightly higher rates and buying long-duration assets such as treasuries. But customers' behavior is shifting, and the customers are withdrawing money from the banks. For what reason? The banks aren't lending, and or the bank's lending is too expensive, or a variety of other reasons that the Fed, the central banks, are trying to get their hands around and control, folks. Just think, this is how things operate now under private institutions. Just wait until there are no private banks and it's all run by one central bank. And the bad news is that This trifecta of problems means that anyone who hopes for a quick resolution up to the bank woes will be disappointed. If the FDIC extends insurance, that would reduce the panic. Surely. A halt to rate rises would reduce the business squeeze. True. But today's mess is the result of a decade of policy mistakes and will not be fixed in 10 days or even 10 months, according to the Financial Times. And particularly if the next chapter of the drama now moves from interest rate risks to credit woes, well, folks, I hate to say it, but this is exactly where we are headed. We're headed to a long duration, long period of time for which decades of poor policy and huge mistakes will not be fixed. And interest rate hikes will continue to go up while credit now becomes the next nail hammered into this coffin that will ultimately be what a lot of people are going to be and businesses are going to be buried in as we progress down this road of banking failures and liquidity risk and crisis. Now, I do want to share with you guys that coming up next, we do need to touch on First Citizens Bank to buy Silicon Valley Bank deposits and loans, and for very good reason. And also discuss further the role of small banks in U.S. lending as we see they are now pulling back. But more importantly, First Citizens Bank to buy deposits and loans of failed Silicon Valley Bank. What does it mean for customers is very important because a lot of people have been asking this a lot. Whereas the question is, well, if my bank were, and it's not just Silicon Valley Bank, if my bank were to fail, if my bank were to collapse, what happens to my loans? What happens to my mortgage? Do I still have to pay these, etc., etc.? Do I get a bailout? We have to discuss that in great detail, folks. So please stick around. You're not going to want to miss that. Subscribe, turn on alerts. Please give this video a like, share it with anybody you think it'll be helpful to. But lastly, this email I received from my credit union, folks, important update, account access. And, I've redacted this because I don't want to create any panic or scare at all. But I did want to share this with you. These are some of the messages and correspondence that we receive after the fact, but a lot of people won't actually see because they're not involved with these institutions. And this is important. And it says, as you may be aware, blank and blank credit union have been experiencing technical issues to our online and mobile banking and phone systems. Our priority remains our members, and we are committed to keeping you informed of this issue. Thank you for your continued patience throughout our restoration efforts. That just means that we're setting a precedent here. And there may have been a glitch. There may have been a temporary prevention of you accessing your account, your funds, your capital, your resources. But we're on it. We're working on it. But basically, this also means that, guess what? It could happen again. We are pleased to share that as of this morning, our core systems have been restored, meaning you can now log into our online and mobile banking platforms. Blank will waive any late or overdraft fees that you may have incurred during the period. We had been experiencing technical issues. Updating account balances to reflect all transactions will occur in phases. First, processing ACH credits and debits, then posting all debit card spending over the previous 48 hours. And lastly, processing all checks and branch transactions. So this is good to hear, but at the end of the day, you have to realize that as these glitches occur, these interruptions occur, not everyone has the ability to pivot and wait for the resolution that in this instance was 48 hours. Diversity, security, cash flow. Folks, please remember these three important pillars. And it says that as part of the technical issues that we are experiencing, our phone systems are temporarily down. Ironic. Banking, online banking, mobile banking app access goes down. Probably ATM access was down, and the phones were down too. Interesting. We are still able to receive voicemails and are addressing member questions and concerns as quickly as we can. Our team is working tirelessly to resolve the issue, and we will be sure to update our members when the phone systems are back up. I'm not even going to talk about that. Meanwhile, our commitment is to do right by our members, and we will continue to provide updates as we have more information to share. We understand that you may have questions as a result of this update, and we urge you to review the prepared list of frequently asked questions listed below. We will continue to update you as more information and resources become available. For any other questions not covered on our website, please email our team at blank, and we will get back to you as soon as we can. And we will do our best to answer your questions and provide you with updates as we work to resolve this issue. Sincerely, CEO of blank and blank. Now, this credit union in particular is actually tied into two credit unions. So we have to understand how these institutions work together, work behind the scenes, and or rely on each other. Therefore, if we see an outage, if we see a failure, if we see a takeover, we see a shutdown like Silicon Valley Bank, you have to realize how many links down the line of this chain it will affect. Outage FAQs, frequently asked questions. Number 1, can I process a transaction inside of a branch? Number 2, I can't believe number 2 is number 2 when it should be number 1. Is my money safe? 3, can I withdraw money from my account? 4, can I withdraw money from your ATMs? 5, what if I am local and not near a branch? That's a big one. 6, how does this impact my automated payments? 7, can I still make a direct deposit to my account? 8, when will I see direct deposits posted to my account? That's a big one. 9, will we be charged any overdraft fees incurred during this outage? 10, can I make loan payments? 11, can I get my balance? 12, will my scheduled deposit and or payments post to my account? And 13, are checks I've written being paid? 14, are automatic payments linked to my account from another bank, such as car payments, being paid? Because those other banks, they're not going to care that this bank had an outage. They want their money. And number 15, who can I speak with about this incident? Folks, this is crazy here. But, these credit unions do have some backing, federally insured by NCUA, similar to the FDIC, slightly different organization, but they do cover the depositors. I don't think that there's any risk here of a loss, but there was definitely an interruption and a little bit of a warning sign of what is likely to come in the future. And folks, this is really important. I think that we all need to be paying attention to this and planning, preparing, protecting. If you guys got questions, comments, concerns, please drop them down below. Appreciate you guys watching. Please give the video a like, subscribe to the channel, and I'll see you guys in the next one. Take care.